exactly as depreciation? It's an expense that represents a deduction for the recovery of the purchase price of a tangible fixed asset over a period of time, called a depreciation recovery period, rather than all at once. Fixed assets include items such as computers, office equipment, furniture, buildings, vehicles, fixtures, machinery, and equipment. A fixed asset is property or an asset used in the operation of a trade or business that does not plan to be converted into cash any sooner than at least 1 year's time. It is also known as property, plant, and equipment, or PP&E. Fixed assets are sometimes collectively referred to as plant. Generally, long-term assets such as copyrights, goodwill, trademarks, and patents are not classified as fixed assets because they are intangible, and more specifically referred to as fixed intangible assets. They have value but can't be touched or seen. Other examples may include computer software. You can see the disks, perhaps, but what is being paid for is the programming that is on the disks. The deduction for recovery of intangible costs is called amortization. Depreciation and amortization deductions are applications of the recovery of capital doctrine, which is based on the concept that the asset acquired or improvement made benefits more than one accounting period. Therefore, the cost of business assets with a useful life of more than 1 year can only be deducted through depreciation and amortization. The methods of calculating depreciation and amortization will be covered later in this session. Incidentally, there are 3 types of tangible assets that are not depreciable for tax purposes. Land, whether owned by a business or individual, is not depreciated. The structure on the land may be depreciated, but the land is not. Secondly, inventory is not depreciated because it holds its value until it is sold. Finally, personal assets not used in business are never depreciated. For instance, your own car or home that is not used in business cannot be depreciated. To determine the amount by which an asset can be depreciated or amortized, you must first know the basis amount. The term basis represents the taxpayer's investment in the property. Basis can be acquired either by cash, debt, or exchange of other property, or a combination of them all. Records related to basis should be kept as long as the asset is owned. Basis for tax purposes is used to determine 2 things: yearly depreciation deductions and gain or loss when the asset is sold or exchanged. The basis of property is usually its cost. The cost is the amount paid in either cash or debt obligations or another property you might have traded for something. The cost also includes sales tax charged on the purchase of the item, freight charges, installation and testing charges, excise taxes, legal and accounting fees, recording fees, and other like fees. If the taxpayer assumes debt, such as a mortgage on a building, basis is increased for the debt assumed. So, if the owner pays $120,000 down for a building and the land that it is on, and agrees to finance the balance of $480,000, then the basis in the building and land is $600,000. Of course, to arrive at the building's depreciable amount, we must determine the land's value and subtract it from the total. So if it's determined that the land is worth $100,000, then the depreciable basis is $500,000. If the taxpayer purchases a group of assets as part of the sale of a business, basis must be allocated among the assets acquired using Form 8594, Asset Acquisition Statement. The allocation is based on the type of assets purchased and their fair market values. You should be able to secure this information from the taxpayer if you ever run into a circumstance where you need it. An asset's basis can be adjusted periodically depending upon changes that occur throughout the asset's lifetime. For example, capital additions increase the original basis, and recoveries of capital reduce the asset's original basis. A capital addition occurs when the asset's life is lengthened, such as when an engine is overhauled in the company truck. Alternatively, the basis will decrease as the asset is depreciated or amortized. Once you know the basis, you must determine the recovery period. For assets placed in service after 1986, two separate depreciation systems under the Modified Accelerated Cost Recovery System, or MACRS, can be used for regular tax purposes: the General Depreciation System, or GDS, and the Alternative Depreciation System, or ADS. For assets placed in service prior to 1986, other depreciation systems may apply, but occur so rarely that I'm going to ignore them for now. They are explained in the workbook. First of all, under GDS, or General Depreciation System, the cost is recovered over a quicker period of time than the asset's useful life. This method is the most commonly used, and for most tax preparers, it's the only method used for depreciation. It was designed to encourage investment and simplify the tax law. Using GDS, most personal property is depreciated over a period of 3 to 10 years using the 200% declining balance method, with a switch to straight line in the last few years. To determine the recovery period's length, there's a chart in your workbook that describes the different types of assets and provides the number of years over which they are to be depreciated. Oddly, farm property placed in service after 1986 may not use the 200% declining balance method, but rather must use the 150% declining balance method. Also, real estate or residential property may not use the 200% declining balance method. Residential real estate is depreciated over 27.5 years, and business property is depreciated over 39 years using the straight line method. Incidentally, straight line depreciation means equal amounts are deducted for each year of the property's recovery period. For example, an asset worth $5,000 with a recovery period of 5 years will be depreciated at a rate of $1,000 per year under straight line rules. The second and less common form of MACRS depreciation, the Alternative Depreciation System, is mandatory for certain types of assets, although taxpayers may elect this method if desired. The types of assets for which the ADS is required includes listed property used 50% or less in the business, property used primarily in a farming business, property used primarily outside of the United States, and a few other rarely used types of assets. Generally, ADS depreciation is calculated using a straight line method and longer recovery periods than MACRS, ranging from 4 to 40 years. By the way, property placed in service and taken out of service in the same year is not allowed a depreciation deduction. Straight line depreciation is used today for intangible property, a patent being a good example. If a taxpayer has a patent and knows it has a remaining life of 20 years, he has to look at the patent's value and divide it by 20 years. That is the amount of amortization he can take each year. Leasehold improvements must be depreciated using straight-line depreciation over the period the structure would be depreciated if that structure was placed in service at the time the leasehold improvements were made. Let me give you an example. We have a business that put a new bathroom into a leased office. The cost of the improvement will be depreciated over the term that an office building would normally be depreciated, which is 39 years for most commercial buildings under the GDS method. If the business vacates the property prior to the end of the 39-year period, which they very well might do, then the remaining book value of the improvement will be expensed in the year of the move. Now, let's discuss Section 179 deductions. Section 179 of the IRS Code permits a taxpayer to elect to write off, rather than depreciate, all or part of the acquisition cost of tangible business purpose property other than real estate. The election is made on an item-by-item basis using Form 4562. Two limitations apply. First, the amount expensed cannot exceed the business taxable income for the year. Second, there is an annually adjusted limit in how much can be expensed. Any amount that cannot be expensed due to the limitations can be carried forward indefinitely to future taxable years and added to other amounts eligible for Section 179, subject to the same annual limitations all over again. Form 4562 is used to report depreciation, amortization, and any Section 179 deductions for all types of businesses, but is used only in the first year that you put an asset in service. If a Section 179 deduction is claimed in a future year on a new item, then it must be reported on a new Form 4562. In other words, if the business has not purchased any new depreciable assets and simply has depreciation on assets purchased in prior years, Form 4562 is unnecessary. So imagine that you purchased equipment to start your new business. Obviously, you'll begin depreciating it the first year, and so you'll need to complete Form 4562 and attach it to your return. If the second year you didn't purchase any new assets, then you won't need to fill out Form 4562. Just include the depreciation for existing assets in the current year along with expenses. Form 4562 has 6 parts distributed over 2 pages. Part 1 is used to calculate the Section 179 depreciation, as I described just moments ago. Parts 2 and 3 are where we record the depreciation for assets purchased during the current year. Finally, at the bottom of the first page in Part 4, you summarize the year's allowable depreciation. Most of page 2 contains Part 5, where we include listed property. As we have discussed before, the term listed property applies to specific assets that are so commonly used for both business and personal reasons that they are subject to depreciation restrictions. This is because of the risk that taxpayers might abuse the business deduction. Listed property includes the following types of assets: most passenger vehicles, and property used for recreation or entertainment such as photographic equipment, audio equipment, video recording equipment, etc. Computers and related peripheral equipment are also listed property unless they are used exclusively at a permanent business establishment. Although listed property is eligible for depreciation and Section 179 expense deduction, the law places special limitations on listed property for cost recovery. In order to verify the legitimacy of the business deduction, the IRS requires taxpayers to maintain written documentation that supports the deduction and apply the 50% use test. The 50% use test means that when listed property is used 50% or less for business purposes, the Section 179 deduction may not be claimed. Furthermore, the asset can only be depreciated using the straight line method. There are special rules limiting the amount of 179 depreciation that can be taken. Congress imposed vehicle dollar limits because they believed that taxpayers were deducting costs of luxury vehicles beyond what was needed for business purposes. If the business use is less than 100%, then the dollar limits are further reduced by the applicable business use percentage. Section 179 expense deductions are only permitted on vehicles if the business use is more than 50%. Part 6 of Form 4562 is for amortization. As you'll recall, amortization is a method of deducting an intangible asset's cost. Most intangible assets are amortized equally over 5 or 15 years depending upon the asset and beginning with the month the asset is acquired. Examples of intangible assets that can be amortized are startup costs, goodwill, non-compete agreements, licenses and permits, patents and copyrights, franchises, and trademarks. So, if in July your client paid $25,000 for the exclusive rights to market products in a specific region for a period of over 5 years, he will amortize the $25,000 over the contract's 60-month term beginning in July. In your workbook, there's a line-by-line explanation of how to complete Form 4562. In fact, the financial components presented in this module are important concepts that you need to understand to properly prepare business tax returns, irrespective of the type of business entity with which you're working. Most of these transaction types are quite common when you're preparing business returns. Please spend enough time in the workbook to fully understand these concepts and tax consequences. In the next session, we will discuss the proper disposal of business property for tax purposes.